Hello all, welcome back. Today we are going to see very important topic from finance point of view, that is time value. Now, I will try my level best to teach you this topic. Now, if you have queries regarding the same, please feel free to contact via chat and I will get back to you. Okay. Now, assume I have invested 100 rupees today in any business. Let's say business A. That 100 rupees in 1 year became 106 rupees. And if I would have kept this 100 rupees in a bank, I would have got 107.5, assuming the interest rate in India is 7.5%. We are just looking from Indian perspective now. So, if you look at these two scenarios, scenario 1 and scenario 2, you will find that 100 rupees today is becoming 107.5 rupees after 1 year by investing in government bonds, which are risk-free. Means what? If you invest 100 rupees in a business and you earn 106 rupees, you are not in profit, but you are actually in loss. And loss by how much? 107 minus 106, that is you are in loss by 1.5 rupees. Now, this profit and loss, considering time value of money, is called NPV. So what is NPV now? Okay, so NPV is also called as net present value, and it is nothing but profit or loss considering time value of money. Now the problem here is how do we decide how much is the time value of money? How do we decide the rate? So let us see that. If you invest 100 rupees today, and if at a government rate it's becoming 107.5, the chances that as per bank rate it might become 110. The chances are that with some risky investment it might even become 115. So which rate should I consider? Now, in order to consider a rate, you need to find the rate for that particular company. So it can be the cost of equity of that company. What is cost of equity? The equity holder expects certain returns, and that is cost of equity. And it can be calculated using capital asset pricing model, CAPM. Now, in this lecture, I'm not going to teach you CAPM. I will just give you the formula. Basically, the formula is risk-free rate plus beta multiplied by return of market minus risk-free rate. Now, what is this return of market? If you are in Indian market, return of market is Nifty. If you are in US market, the return is S&P 500. So the index of that particular country is the market. Now, approximately 10 years return of Nifty is 14%. Risk-free rate in India is, let's say, 7%. So, beta. What is beta? Beta is a relationship between stock and the market. So, if beta is 1.2, what does that mean? That means that if market increases by 1%, my stock will increase by 1.2%. Similarly, if market decreases by 1%, then my stock will also decrease by 1.2%. This is an average increase and decrease, and not every time. Now, so the rate can be cost of equity. The rate can be return on investment. The rate can be weighted average cost of capital, WACC. We are going to see that in our next lecture. Okay. But there is some rate, and that rate is called discount factor. Now, let us try one simple example. Now, let's say 1, 2, 3, 4, and 5. These are 5 years. 100 rupees is the profit. Now, always remember, whenever I'm doing capital budgeting, I will always consider cash profits. Now, what are these cash profits and what are normal profits? That we are going to see next. But right now, assume that 100 rupees is my profit every year, cash profit. And my discounting factor or discounting rate or return on investment, WACC, cost of equity. Let's see that as a 10%. What does that mean? I need to find out the value of cash profit, which I'm going to get 100 rupees after 1 year, its value at year 0. And that is called discounted cash flows. Now, how do we convert our cash profit into discounted cash flow? Now, the formula is very simple. 1 upon 1 plus discounting factor is the formula. And that discounting factor rate, that will give you your discounting factor. Now, rather than doing it here, what I would like to do, I would like to take you to the Excel sheet, because in Excel you can calculate it quite easily. So let me show it to you how we can calculate NPV. Okay. Now, 1, 2, 3, 4, 5. I hope it is visible. Let me just increase the size of screen. Oh. 0. These are what your years. Now, in year 0, let's say you did an investment of 250. And from year 1, every year you are getting a cash profit of 5 years. Here, discounting rate is 10%. This is your cash. Now, discounting factor will start from year 1, because for year 0, there will be no discounting, because is equal to 1 upon 1 plus 10% raised to power the year. So if this is first year, it will be 0.909. Next year, 896.826, then 751, 683, and 620. I will just decrease the, yeah, this is better. This is not better. Now, discounted cash flow is equal to cash profit multiplied by discounting cost. Now, please understand what I am doing here is that if I am getting a profit of 100 rupees after 1 year, it's 2 days, means 0 years value will be 90. If I am getting 100 rupees after 2 years, it's 0 years value, means today's value will be 82.6. So we will always be calculating 0 years value. Now, when you add all these discounted cash flows, when you sum it, you get cumulative discounted cash flow. And from that, when you subtract your initial investment, how much was your initial investment? 250. What you get is your NPV, that is 129.08. Now, in Excel, you can directly calculate NPV. I will show you. The formula is equal to NPV rate. So how much is your rate? Rate is 10%, comma. Always remember, when you give values for NPV, do not give 0 year value. Start from first year, take all the values, close the bracket, and then add 0 years value if it is in negative. If it is in positive, if you do not use the sign, when cash is going out, sign is negative. When cash is coming in, sign is positive. Then you subtract it. And they have given it in percentage, convert it into number, and voila. Look, your NPV, which we have calculated, and the NPV which Excel has calculated is coming out to be same. Now, always remember this. Look what I have done. I did plus C3 because C3 is already in minus. Now here also, if C3 is in minus, then you need to do addition here also. So you need to add here, and then your answer will be correct. So in both the ways you can do, but always remember one thing. NPV is based on cash profits. When you invest something, cash is negative. When you get something, cash is positive. Now, considering time value of money, if you are trying to find out profit and loss, that is called net present value. In our next lecture, we will be studying about IRR. Please let me know if you understand this. If you do not, don't worry. In next lecture, I am going to speak in detail about time value of money again. I hope you enjoyed the session. If you enjoyed the session, you know what to do. Thank you very much. I hope.